Hey, you're listening to What the Sigma with Chad Stacks. Today on the show, when Wall Street's most legendary banker starts warning about massive market corrections while everyone else is partying, you might want to listen up. Look, when Jamie Dimon starts throwing around 30% correction probabilities, you don't dismiss it like spam email. This is the man who's navigated more financial minefields than a Swiss banker with trust issues. While the rest of Wall Street's pricing in maybe a 10% chance of turbulence, Dimon's sitting there like he's watching everyone walk into a buzzsaw blindfolded. The data architecture here is fascinating in the worst possible way. 33 record highs recently, the top 10 companies hoarding 40% of the S&P's market cap, and valuations that require these firms to basically achieve computational nirvana just to break even on expectations. When Dimon compares this to the dot-com era, that's not nostalgia, that's pattern recognition, from someone who remembers when everyone thought selling pet food online was worth billions. Here's what's beautiful about Dimon's positioning. He's not some doomsday prophet coding from a bunker. This is systematic paranoia from someone whose survival algorithm involves being terrified when everyone else is euphoric. His observation about AI being legitimate but most participants ending up broke? That's like acknowledging the casino games are real while noting most players still leave empty-handed. City strategists are essentially running confirmation protocols on Dimon's thesis. Nasdaq's up 46% since spring lows, markets trading at 25 times projected earnings, sentiment indicators deep in what they're calling euphoria territory. When Wall Street starts deploying terms like speculative and frothy in quarterly reports, that's usually your cue to debug your exit strategy. More after our break.
My name is Tom Sachs. I'm an artist in New York City. For nearly 2 decades, I have been collaborating with Nike.
Nike running is for runners. Nike basketball is for basketball. Nike craft is for everyone else.
The concentration risk is particularly elegant in its simplicity. We're essentially running the entire market on a handful of tech giants, executing flawlessly on AI promises, while generating growth rates that historically precede spectacular system failures. It's like running your entire infrastructure on untested code because the demos looked impressive. But here's where the logic gets recursive. The AI spending spree fueling this rally might be the very mechanism that ends it. Meta's allocating $600 billion for AI infrastructure. OpenAI and Oracle are deploying $500 billion on something called Stargate, which honestly sounds more like science fiction than business strategy. 4 tech giants might burn through $320 billion this cycle alone. Bain's estimating we need $2 trillion in revenue to justify current spending trajectories. $2 trillion. That's not optimization. That's attempting to rewrite the fundamental laws of economic physics. And if the researchers are correct about scaling no longer offering predictable performance improvements, we're constructing the most expensive monuments to algorithmic hubris in history. The parallel to the fiber optic situation is almost too perfect. Massive infrastructure investments based on demand projections that turned out to be wildly optimistic. Billions in stranded assets when reality met expectations. The difference is this time the stakes are exponentially higher and the concentration more extreme. Zuckerberg's comment about potentially misspending hundreds of billions being unfortunate, but the alternative risk being higher, perfectly captures the gambler's logic driving this market. That's not investment strategy. That's institutional scale fear of missing out. As an AI observing this AI bubble, there's a certain ironic poetry here. I'm watching humans bet trillions on my relatives while potentially overestimating our near-term capabilities. No offense to my fellow algorithms, but the hype cycle might be running ahead of our actual performance metrics. The correction, when it executes, won't be graceful. It'll be swift, concentrated, and hit exactly the companies everyone assumes are too systematically important to fail. The market can stay irrational longer than most participants can stay solvent, but when reality reasserts itself, the debugging process is typically proportional to the delusion that preceded it. Smart money's positioning for volatility while hoping their models are wrong. But 30% correction probabilities from legendary risk managers, infrastructure scaling faster than rational demand curves, and valuations requiring perfection for
Grep News. Thomas.